Let's talk to Tim Gregory. He's the Chief Investment Officer at Vermeer Investment Management Limited. Very good morning to you, Tim.
Morning, Nick.
Right, let's talk about global equity markets. Lots of commentators have been saying that we are in the ninth innings in terms of the bull market. A few commentators said it was different this time. We were only in the first, which raised a few eyebrows, particularly with mine, which reminds me I do need to go to the barbers. Are we in the ninth innings? Should we be basically listening out for the music to basically switch off and us all to leave the dance floor?
Well, I think what we've seen in the last few weeks is, after a really strong start to the markets this year, that period of irrational exuberance has now come to an end.
Yep.
People have switched to recognising that valuations got very stretched. They were ignoring the significant rise we've seen in the 10-year US Treasury towards 3%. In fact,
Yep.
I think the fact that we get to 3% is now discounted, and we could get there tomorrow depending on the US CPI data, which could be pivotal to how this week goes. So I think the peak that we saw on the S&P of about 28.72 a couple of weeks ago, I think that's going to be very hard for us to get above that anytime soon.
Okay.
So for now, the bull market may be over, but by the same token, we may not be in a bear market. So we've seen a sort of 10% correction.
Yep.
Seen a bit of a rebound from that, and markets highly volatile still, and I suspect that will continue. So I think we could be in a phase where we're in more volatile markets, but once we settle down, we could be somewhat range bound, with the peak that we saw in January
Being the high of the year.
not necessarily the high of the year, but certainly the high for some time.
Right.
So, and I mean, it could be, but you know, I think whereas in Japan, for example, which, as you know, we've been long-term structurally very bullish about, we still are very optimistic. There we see valuations on 15 times as opposed to the US now on 17 times after the fall, so still not back in cheap territory.
Yep.
We see an earnings season that has been way ahead of expectations. We see cash-rich balance sheets and 10-year government bonds at 0.07 against equity yields at 2, whereas in the US, 10-year US bond yields are now 3, or nearly 3,
Yep.
or discounting 3, and equities yield about 2%. And, you know, obviously people have started to worry about things that they pushed to one side not that long ago, like the deficit.
Okay, so at market tops, invariably everything looks at its best. And in terms of the data points, okay, absolutely fantastic, the global economy, okay. When will we know if this is a market top? Okay, we've had a 10% pullback. All the clever people are going with, right, this is the beginning of the bear market. This is going to be a stock market crash, okay. This is a consolidation, okay. What do you look for in market tops?
Well, I think one thing that has been apparent in the last 10 years is that this was a bull market, sorry, from March 09, so best part of 10 years, this was a bull market nobody loved until about 6 months ago, when I think there was an element of people feeling they needed to be in the market because they'd missed out on something, and there was going to be a further...
Because there was record inflows in January this year, wasn't
that's right. That often marks a short-term, sometimes a long-term top in the
And
market.
record M&A in January this year that dated back to, hadn't been peaked in 2000.
Indeed. So any number of signals that markets were coming to a peak.
Right.
Which, of course, you only see with the benefit of hindsight, because we can all look back and say, oh, well, it was obvious. And, of course, you know, valuations have been stretched, but they've been stretched for a long time. But the big shift is the 10-year US Treasury yield, because it's not that long ago that 10-year yields were at 2. And although expectations for interest rates were for 3 interest rate rises, you saw for a while towards the end of 2017 a period where, although short-term interest rates were forecast to go up, the yield curve was flattening. Suddenly, that has switched round. Mr. Trump has got through his tax reform. He plans to spend a lot of money. People are worrying about the deficit, worrying about a return of inflation. And suddenly those issues that have caused the yield curve to steepen have given investors pause to think about how much markets have gone up, where valuations are, and raise questions. And that's why I think we're going to be in for a period of volatility, and we're going to be range bound for a while. And that previous peak that we saw of 28.72 is going to be very tough for the markets to take out for some while.
Okay. All right. So finally, to wrap up, in terms of, you've talked before about you like the banks at the moment because of the environment of rising interest rates.
Sure.
Fed potentially going 4 times this year. If inflation basically started to really tick up, are there any particular sectors you would be looking to invest in, or more importantly, in sectors you would not be investing in?
Well, I think if you see a continuation of this steepening of the yield curve caused by inflation expectations, you should see commodities do better. And if interest rate expectations continue to rise, utility markets, which have struggled, will continue to do so. So, as you know, you mentioned that we're overweight the banks and we're overweight the materials sector with a blend of some, mining and oil-related assets uncombined, and some infrastructure plays, which are not utility-based infrastructure plays, in more like rebuild, reconstruction, infrastructure spend type plays. So we favour those types of plays in a rising inflation environment. If we see that, and that still remains
that's $1 million question, right?
And that's why we have run a balanced portfolio for the last 12 months. We can run up to a maximum of 60 stocks, and we've been close to that maximum because we've chosen to run with balance for the last 12 months because the outlook is more uncertain now than it has been for a long time.
Tim, on that note, thank you very much indeed.
Thanks for your time.